The 18-month crash pattern explained. Are we entering stage 5 of a 1929-style collapse? Right now, late 2025, a pattern is unfolding that mirrors one of the most catastrophic financial crashes in history, the Great Depression of 1929. This isn't alarmism or speculation. It's pattern recognition rooted in decades of market cycles, mathematical indicators, and historical trends. And if history repeats, because it always does, we're on the verge of a major prolonged decline that could wipe out billions in wealth over the next 18 months. Today, we're going to break down this pattern, identify the key signs to watch for, and reveal what steps you can take to protect yourself before the inevitable bottom drops out. This isn't just about guessing. This is about understanding the cycle and acting wisely. Let's start with the basics. The 1929 crash played out in clear stages, each one predictable if you understand the pattern. Today, experts see ourselves in stage 5, the critical tipping point where everything becomes undeniable. In 1929, the market was at its peak in September. Valuations were disconnected from reality and everyone was euphoric. Insiders who knew the true state of their companies began quietly selling. Margin debt was dangerously high, about 8% of GDP, and the public believed stocks could only go up. Fast forward to November 2025, and many of these warning signs are flashing again. Record insider selling, Warren Buffett's massive cash hoard, sky-high valuations, and margin debt approaching dangerous levels. Despite these signals, the market keeps climbing, detached from economic realities. The pattern is set. We're in stage 5. In 1929, the actual crash played out over approximately 18 months. It started with a small crack in October, followed by false hopes of recovery, then a grinding decline that culminated in outright disaster. The famous Black Thursday and Black Tuesday marked the beginning of a cascade of sell-offs. Over this period, the Dow lost about 58% of its peak value. But the real devastation, an 89% wipeout, came in the following years. The initial phase of systemic wealth destruction set the stage for a decade of unemployment, bank failures, and social upheaval. Today, the pattern suggests a similar timeline. From November 2025, a countdown begins. If the pattern holds, by May 2027, most of the wealth transfer from over-leveraged investors to the prepared will have happened. The next 18 months are critical, marked by sharp declines, false rallies, and eventual capitulation. So, what are the signs to watch for? Here's a checklist. Volatility spikes, heavy trading, erratic swings, and increased choppiness suggest distribution, smart money moving out. Sudden sharp drops. Expect 3 to 5% drops in a day, followed by brief recoveries, then larger drops of 5 to 8%, and eventually a 10 to 15% plunge over days. False rallies. After initial declines, markets often bounce 10 to 15%, luring in retail traders. These are dead cat bounces, fake recoveries before the real crash resumes. Prolonged decline. Months of slow, relentless drops with new lows each month erode confidence and trap the unwary. Economic deterioration. Rising unemployment, collapsing corporate earnings, failing banks, and declining industrial output mirror the late stages of 1929. The psychological toll is brutal. Investors who buy the first dip often get wiped out in subsequent declines, losing 80 to 90% of their portfolios. Meanwhile, the wealthy, who recognize the pattern, wait patiently, accumulating assets at fire sale prices. Historically, the market bottom, like 1932, has been the greatest buying opportunity for those prepared. In the coming months, expect more false recoveries, headlines declaring the worst is over, and retail investors convinced they've missed the bottom. So, how should you prepare? Recognizing the pattern is just the first step. Here's a 4-phase plan based on what history shows. Phase 1. Now, November or December 2025. De-risk now. Cut back if heavily invested. Take profits on speculative assets and meme stocks. Consider buying protective puts, options that profit if markets fall, to hedge your portfolio. Phase 2. December 2025, January 2026. The cracking begins. Expect a sharp fall of around 10 to 15%. Resist the urge to buy the dip prematurely. Instead, prepare to sell during the relief rallies. Phase 3, February to June 2026. The grind. Expect months of slow, downward drift with failed rallies. Stay patient, keep cash on hand, and avoid panic selling. Phase 4, July 2026, March 2027. The capitulation. When markets fall 60 to 70%, unemployment rises, and fear peaks, deploy capital cautiously. Dash focus on resilient, high-quality companies like Apple, Microsoft, Johnson & Johnson, those likely to survive and thrive. This pattern isn't a crystal ball prediction. It's a logical, historical projection. The cycle of 1929 to 1931 repeats with remarkable precision. The signs today point toward a multi-year downturn, one that will redefine wealth, power, and opportunity. The key is survival. Protect your capital now and position yourself for the massive wealth transfer that follows. The clock has started. The signs are clear. The pattern is unfolding. Will you recognize it in time? The next 18 months could be the most defining period of your financial life. Will you be ready?